Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Thursday, August 3, 2017. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And as you can see today, the volume was extremely light. We did 40 million shares in the SPDR against a daily average volume of 62 million shares. That's a 90-day average, and it's declining. And we're in the summer doldrums. Nothing's changed. My outlook hasn't changed. Nothing's changed really from yesterday. Everything stays the same. We have this bearish pattern from a short-term perspective, and I'll just draw it out one more time. Okay, so from a short-term perspective, it's a bearish pattern, okay? And generally, you're going to see a down move out of that pattern. However, we have the phony jobs number tomorrow, and more often than not, when the markets are quiet, and we have a phony jobs number, it doesn't really matter what the number is unless it's something absolutely terrible. But if it's a decent number, a lot of times it can act as a spark. And the spark in this case would be the excuse for them to drive the market up one more time into the culmination of what I believe is a cycle turn that's coming, and we should be days away. Whether it's the end of next week or into the following week or even into around the 21st of August, that's about as late as I could see it turning. We should get the turn that I've been discussing, and we should get some downside activity in the market, and that should last through the fall season. Now, the bigger picture is we have a bullish pattern. And while the technicals still point to the downside from the short-term perspective, what I just mentioned, the longer-term perspective, when you just look at a longer-term view of the chart, this is still bullish, okay? And we're above all the moving averages, and you know what this promotes another move that way. And we're still above all the moving averages. Again, I'm not going to go through everything I just discussed last night. It's just, I feel like I'm repeating myself, and I get that. I want to give you the analysis. I want to give you everything I have constantly, but frankly, there's not a lot of change from yesterday to today. Everything pretty much remains the same. And that happens as we're leading up into one of these phony job reports that comes out at 8:30 a.m. Eastern Time. The market kind of goes to sleep. And we saw that happen for the majority of the trading day today, the lion's share of the middle part of the day. We saw a little bit of a dip at the end of the day and then a recovery. The futures recovered, and we're basically where we started from. I mean, the SPDR finished down 15 cents. The S&P 500 or the XPSX cash index is down 5 points today. And, that's not that big of a deal. Nothing really happened from a material change standpoint from yesterday. It just didn't take place. And that's common and normal market behavior leading up into a phony jobs number. They can use the jobs number as the spark and the excuse to drive the market higher if they want to do that, and that would lead us to 2,500 in the S&P futures contract, maybe 2,510. That would lead us to 249 in between. We'll just give it a range and say 249 to 250 in the SPDR. And I have to believe those big round numbers, and let me rephrase that, those big juicy round numbers will be hit before this whole thing is said and done and we get some kind of a meaningful correction in the market. That's my take. I'm not changing that tune unless proven otherwise. And it's not unlikely and it's not uncommon for the market to have a blow-off rally, a blow-off top into the culmination of the cycle turn. And think about it for a second. Let's say that happens and tomorrow starts that. I'm not saying we're going to do the whole thing tomorrow. I'm just saying tomorrow starts some kind of a rally and it lasts into next week. And into next week starts really where I thought the span of time that I thought we would have for a cycle turn was the middle of July to the middle of August. And we're getting into, next week starts getting into the middle of August already. The end of next week is the 11th. Next Friday is the 11th of August. So my antennas are up. I'm watching everything like a hawk, as you know. And if we see a blow-off top, that may be the perfect recipe for the culmination of the cycle top at a huge, fat, round number of 2,500 in the futures, 250 in the SPY, into the date, into the cycle turn date. I mean, it just couldn't get any more perfect than that. It's going to come out different. We all know that. Nothing ever comes out perfectly as we map it out. That's just the way the market is. However, we can obviously see that picture developing right before our eyes, and we'll see what happens. But again, the daily chart of the spider from a longer term perspective is bullish. The weekly chart we looked at last night is bullish. There's nothing wrong with the market. There's no signals of a turn. So we just wait for the market to tell us what it's going to do. Going over to the IWM, we saw another day down 0.5% in the IWM, another drift lower. So again, from a technical standpoint and from a market leading indicator standpoint, the IWM is saying something. It's talking to us, right? So forget about the upside in the market that I just discussed, what I see happening. That's really an opinion, right? From a technical standpoint, remember, I'm separating, like last night, I'm separating opinion from fact and what the technicals are telling us. So on one hand, the longer term technicals aren't telling us anything except the market is bullish. From a short term perspective, we could see downside. That's what the shorter term technicals are telling us. And certainly when we look over at the IWM and my favorite leading indicator of the market, it's drifting lower. But look where it's coming. It's coming back into a very important price zone. The 138.74 is still important. Whether it's 138.78, 138.95, not really material at this point. The point is we're coming into a price zone where this should be supportive of the market. Now, where does this price come from? This price comes from the low of this green candle, which is 138.74. So I'm saying that this, in effect, is still a bullish pattern that has not been broken. Here's an up move, and we chopped around here for a while, back and forth, still back and forth. But guess what? This is still a longer term bullish pattern that could still have another upside move in it. All right, so we're paying very close attention. I'm watching everything like a hawk. Last night I discussed the fact that yesterday was day number 7 from the most recent pivot high, and today was another down day. So I was looking for a possible turn today. We didn't get it. And so we'll see what happens tomorrow. Tomorrow's a big day. You're going to get all the markets moving tomorrow on the phony jobs number. That's just the way it is. You'll get stocks moving. You'll get bonds moving. You'll get currencies moving. And whether or not they only move for a half an hour, 2 hours in any meaningful magnitude, that's okay. Because generally speaking, after that occurs, the market's going to pick a direction and do the drift for the remainder of the session. And specifically tomorrow being a Friday, we know that the market's going to generally go to sleep on Friday, probably 8 out of 10 times. And if the market's higher after the jobs number, the market will trend higher for the rest of the day. That's the likely scenario. If the market chooses to say the jobs number is poor and we go down as an excuse with the jobs number, that could be a different story. And certain days, certain Fridays, if they're few and far between, but we do see Fridays where we get hard sells and we get a perpetual sell the remainder of the day. I don't know that's going to be the case. I don't know it won't be the case. All I know is whatever direction the market picks as a result of the excuse of the jobs number is generally going to remain intact for the remainder of the trading day. Tonight I want to look at the VIX a little bit, right? Just from a pure technical standpoint, I want to make sure that we understand the technicals versus an opinion, because here's what the technicals of the VIX are telling us. It's bullish, okay? I mean, you can just see right here, you have a big up move, you have a decent size up move. Now we have bullish consolidation. It's a wedge pattern, all right? It's wedging down. We're going sideways. Tomorrow's the 7th day of going sideways, or tomorrow will be the 7th day. We went sideways for 6 days. Are we going to break out to the upside, which means the stock market's coming down? Or is this pattern going to either fail or test down near the lows of this candle, which is, 9.25 area, give or take, in that neighborhood, retest the lows? We'll see. Everything's going to happen at 8:30 in the morning, at least beginning at 8:30 in the morning. Now, the transports were up slightly today, and they came in yesterday to test the 200 period moving average. We had a little bit of an update today, but all in all, the technicals say this is a bearish pattern. In fact, it's more of a bear flag pattern than anything else, right? So we have in the lower portion, lower 20% of this candle is where the market is. And the longer we go sideways like this, the more likely we are to complete the flag pattern in the downward direction, headed down toward double bottom. We'll see if that's the case or not, but that's what the technicals are telling us right now. But everything could change with the jobs number tomorrow. But remember, the transports had a pretty big sell-off. And if you think about it, even with a positive market tomorrow, the transports could have a big up day and still stay inside this red candle and still remain in a bearish pattern, even with a big up day tomorrow. So there is some conflicting data here, and there's still some divergences that exist, and that's the market's way of not necessarily making it extremely easy to analyze and forecast. That's just the way it is. Looking over at gold, look what gold did today. It came down to test the lower portion or the bottom of the green candle, which was 1263 spot 20. Pretty sure we mentioned that last night. Soon as it got there, we pierced it through by a little bit, making a low of 1262 spot 90, 30 cents lower, and then we rocketed higher, finishing, or where we are now is 1274 spot 60. That's bullish, okay, but we'll see what happens. We're definitely, I shouldn't say definitely, we generally get a lot of movement out of the metals market as a result of the phony jobs number. So I don't know if we can get any information out of today's activity in the gold market yet, but we should get movement tomorrow, and we'll see. If we get a spike higher, I'm looking for, not that it's going to happen all in one day, but if and when we do get to 1,300 or beyond, I'm telling you, it's a stone cold short. That's my take. Obviously, with any trade, there's risk. You have to have a reasonable stop, but as far as I'm concerned, at 1,300 to 1,307, I will be shorting the gold market. As far as a trade right here, still nothing. We're in the middle of a range. We're consolidating sideways. There's no high probability trade right now, and so we'll just leave it alone, and we'll play the extremes. I like to play the outer edges. Your odds are better. The probabilities are higher when you play the outer edges of a market. And what do I mean by that? Here's an upper range. This is an outer edge. Here's an outer edge. Here's a middle of a range. We don't want that. We don't want to play here. You don't know which way it's going to go. If you put in a pattern, that's at least increasing your probabilities of success, but all in all, it's still a lower probability of success right now than playing the outer ranges. When you look over at silver, we're down 0.5% today, but again, same deal. This could be easily making a bullish pattern to build energy for another spike higher. Same deal. We already know that we hit some resistance levels. We hit some important retracements. I'm not going to rehash that stuff. We had a down day of about 0.5%, but we finished well off the lows, so it was a positive close. Doesn't matter that it was down. It's not really how they trade them each and every day. It's how they close them each and every day that's important. And when I look at the silver market right now, we're butting up against the 50-period moving average, but they seem to be closing them much more strongly than they traded them throughout the trading day. That's positive, but anything goes with tomorrow's report. All right, so let's move along to the crude oil market. And here's a market that was down again, down about 1.33%, still obviously trading here. We talked yesterday that yesterday's movement could have just been a retracement from the reversal candle we got the prior day. So on Tuesday, we got the reversal candle. Yesterday, we see a retracement happen. Today, we even retraced slightly higher and failed and are headed lower. Now, are we going to head lower? Are we going to get to 48? I think we're going to get to 48. That's my take. and they could get it all done based on the jobs number tomorrow, the non-farm payrolls as it's called. I keep calling it the phony jobs number, and I apologize if I'm offending anybody, but all in all, it's the non-farm payrolls report. And I frankly I don't know what they have against farmers, but it is the non-farm payroll report. Farmers are one of the most important cornerstones of this country, and they continuously have a non-farm payroll report. So I just take it at face value and think it's ridiculous. Anyway, back to the crude oil market. I think 48's in the cards, but again, anything goes at 8:30 in the morning. They will use it as an excuse to whip the markets around, and by the time the market opens at 9:30, it will already have a direction in all the markets, and that will likely be the trend for the day. Look where we are in the bond market, right up against the upsloping trend line that has been on the chart for quite a while. We've been watching this trend line. We've been watching how the bond market is respecting this trend line to a very large degree. It's very interesting if they're going to get above and stay above this trend line. This is not necessarily a trend line that's just for the bond market only. This is a trend line that you can draw on any chart whatsoever, any time frame, 10-minute chart, hourly chart, daily, weekly, monthly, doesn't matter. They're all the same. And you can see how this market respected this trend line a couple of times. So once we got below it, we rallied back to it, popped above it one time, tried it a couple of times, but really only closed above it one time, and then were rejected. We made a bearish pattern, and now this bearish pattern is technically off the table because we got above, and today we'll close above this high, which was at 154.11. But this trend line is still holding the market. I think it's fascinating. I think it's interesting. I think this trend line will hold the market. We may spike it, we may do a throw over, and we may fail at the trend line one more time. My bet is the trend line holds all in all, and from a longer term perspective, I think this trend line will reject the market one more time and we go lower. If they want to pop the bond market up a little bit, okay, they can pop the bond market up to this next consolidation area, right? This would be the next area that they would pop the market and it would find resistance, give or take a couple of ticks here and there. But that's really the next level. Beyond that, it's double top, but I just don't see it. Anything can happen, but I just don't see it. I still think on a daily chart closing basis, this trend line's going to hold, and we'll come back tomorrow and see whether I was right or whether I was wrong. And when you look at the dollar, nothing happened today. I'm not so convinced that yesterday was a reversal of any sort. When we look over at the weekly, we did pierce the 200-week moving average, but I'm not calling anything in the dollar right now. I'm waiting for tomorrow's close. Tomorrow will be the weekly close, and tomorrow is going to be important because we may get some movement out of the dollar on the jobs number tomorrow, or quote-unquote the non-farm payrolls report. We should get movement in currencies. We should get movement in the dollar. It'll be interesting to see if the dollar catches a rally and puts in a weekly bottom based on tomorrow's activity. I'll be very interested to see how that or if that develops at all. And I'm going to wrap it here tonight. It's everything I wanted to discuss. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.